We now turn to cost of goods sold, also referred to as cost of sales. Now, cost of goods sold represent the company's direct cost of manufacture for manufacturers or procurement for merchandisers of a good or service that the company sells to generate revenue. So when we're talking about what cost of goods sold really are, these are direct expenses. So the expenses associated with purchasing inventory for a merchandiser or manufacturing goods that are going to come up into your inventory and then they're going to be expensed out on your income statement. So things like raw material costs, direct labor costs, factory overhead, these all represent costs that end up comprising the cost of your inventory, which then becomes your cost of goods sold. Shipping and delivery costs of your products, any other costs directly associated with the generation of revenue, as well as depreciation of specific machinery used in the direct production or manufacture of these goods. And we're going to talk about depreciation as a unique type of expense. Now, remember that many of these costs that we're talking about here are not going to be immediately recognized. For example, merchandise inventories are only recognized when the revenue from their sale is recognized. But this is what ends up ultimately flowing through cost of goods sold. So a couple of things to keep in mind about what cost of goods sold is not. It is not corporate overhead, marketing, administrative expenses, research and development, salaries of employees that are not associated directly with the manufacture or procurement of a good or service. These are things that are not included in cost of goods sold, but are rather included in operating line items that we're going to discuss shortly, like selling, general, and administrative expenses. Below, we've outlined examples of expenses that once sold would be classified as cost of goods sold. So the expenses associated for a manufacturer with the purchase of inventory. So for example, the cost of tires, the Michelin cells, that's going to be counted as an expense. It's going to hit cost of goods sold. Direct labor. So the laborer is working on an ExxonMobil oil well. That's going to be wrapped up in the cost of the oil and the cost of goods sold that ExxonMobil recognizes. Factory overhead, this is also called indirect costs. But the rent, the heat, the administrative salaries and equipment maintenance costs, custodial costs in a General Motors automotive plant. Again, administrative salaries outside of the plant where they're directly manufacturing cars, that's not going to count. But the rents and heat, administrative salaries, all these things that are directly associated with the manufacture of the goods, that's gonna count as cost of goods sold as opposed to something like selling, general, and administrative expenses. And lastly, shipping and delivery costs, the lumber delivery costs for, say, a big lumber firm like Sierra Pacific. They're delivering the lumber, that's gonna hit cost of goods sold as opposed to some other line item. Now, for a merchandiser, it's a lot easier. If a Walmart buys a TV from a supplier, the cost of that purchase for Walmart is going to be recognized as cost of goods sold. The only other thing that tends to impact cost of goods sold for a merchandiser is the shipping and delivery cost. So for Apple, for example, shipping and delivery cost of Apple's inventory. Apple, by the way, is both a manufacturer and a merchandiser. They not only manufacture their products, they also sell them. But so shipping and delivery cost of Apple's inventory, that's going to count as cost of goods sold as well. For a service provider, direct service costs are going to hit cost of goods sold. So for example, Google's payments to its advertising network. And this is a little bit trickier, but for example, when Google has its advertisements running on its affiliate website, the payments that Google has to make to those affiliates, that's going to be recognized as a direct cost of goods. Let's talk about the ultimate service company, like a consulting firm. The compensation of Huron consultants that directly generate consulting fees, that's going to be their direct service cost. That's sort of the equivalent of a cost of goods sold line, as opposed to something like selling, general, and administrative costs. So here we look at some real disclosures of cost of goods sold. Here we see Walmart has revenues of $446 billion with cost of goods sold of $335 billion, by far their biggest expense line item, which you would expect as a merchandiser. The biggest expense you have is those inventories that are cycling through the income statement. And now we've also included a disclosure that we see here for Walmart. The cost of sales include actual product cost, the cost of transportation to the company's warehouses, stores and clubs from suppliers, the cost of transportation from the company's warehouses to the stores. This, by the way, comes directly from the footnotes in the 10K. Let's look at another company, Google, a service provider. Here we see that Google generates revenue of $38 billion and recognizes cost of goods sold, which it calls cost of revenues, of 13, and let's look at this year. They generate revenues of $60 billion, of which $24 billion, again, also their biggest expense line item, is their cost of revenue. What is their cost of revenue? It consists primarily of traffic acquisition costs. And this is amounts paid to Google network members under their AdSense program. And so when you've got other websites running Google ads, Google collects the revenue and recognizes the revenue from those ads. But then, of course, the massive payouts that they have to make to the network, to the websites that are running the ads, that counts as cost of revenue. Let's look at Huron, a consulting firm, and we see that they have revenue of $787 million. And we see that $443 million of that represent direct costs. That's so the equivalent service term of cost of goods sold. And here we have a footnote in their financial statements as well, that direct costs consist primarily of revenue generating employee compensation and their related benefits and share-based compensation. So the direct costs for a consulting company are its consultants. So now let's go through a question to better understand what's included in cost of goods sold. Which of the following examples constitute costs that would be eventually recognized as cost of goods sold? Give it some thought, hit the pause button, and come up with your answer. When you're ready, hit unpause and we'll talk about the answer together. So let's talk about this. Cost of steel for an auto manufacturer is going to go into their inventory costs. It's going to get wrapped up in inventory costs and then cycle through cost of goods sold. So that is certainly a direct expense that's going to count as cost of goods sold. The cost of a cashier at an Apple store is not cost of goods sold. This qualifies as a selling cost. Cashiers are part of selling, general, and administrative expenses, and we're going to get into that shortly. The cost of management offices at a tire firm, that's an SG&A cost. It's not tied directly to the manufacture of tires. It's corporate overhead. And so that's not a cost of goods sold. The cost of computers acquired by a merchant for resale to the public, though, certainly counts as cost of goods sold. Those are direct costs. Cost of research and development is its own special category. That's not going to count as cost of goods sold. And lastly, the cost of a factory supervisor at a tire plant, unlike the cost of management for a tire plant, the cost of a factory supervisor at a tire plant is a cost of goods sold because even though it's not direct labor, it's considered factory overhead or indirect labor, and that's captured in cost of goods sold as we've talked about. Now, we're going to get to ratio analysis towards the end of this course, but certain ratios are just so important to come up time and again that it's just part of the basic lexicon of understanding accounting. So gross profit represents profit after only direct expenses have been accounted for. So it's net revenue minus cost of goods sold. So here we have another exercise, very similar to the exercise that we just went through, but requires you, instead of identifying what goes into cost of goods sold, is we've given you a fact pattern here, and we'd like you to try to calculate gross profit given that fact pattern. So again, why don't you hit the pause button, give this a shot, and we're going to talk about it together. So let's go through this. The trick was to understand that the purchases of rubber raw material and the amount of spending on factory overhead and on direct labor does not necessarily equate to the cost of goods sold figure. So if the tire producer recorded $100 million in net revenue, the fact that they purchased $60 million in rubber raw materials, $7 million in factory overhead, $5 million in direct labor actually doesn't matter. What matters is that $40 million in tire inventories were used up in the sales that generated the $100 million. That's that matching principle. And just as a side note, $30 million in raw material costs, $5 million in factory overhead, and $5 million in direct labor comprise that $40 million. But ultimately, this is the number that we are going to really worry about. This is the number that's going to be recognized as cost of goods sold due to inventories. But in addition, the tire producer spent $2 million in shipping the tires. We're going to count that as cost of goods sold. And the tire producer spent $4 million in office supplies and $2 million in R&D, and that's not going to count. That has to do with things that are going to be distinct from cost of goods sold. So when we look at this doesn't count, this doesn't count, but the $40 million and the $2 million do count. So let's go to the next slide, and we exactly see that the $40 million in inventories that were used up, that's what's counting, and the $2 million in shipping is what's counting. And you add that up together, and you have 42. You subtract 100 million minus 42, and you get this 58 million as your total cost. And that's all about the matching principle.